Okay, and we are live. So, hi, I'm Jason Hull, and I'm here with Noel Christopher, Noel of Renters Warehouse. Noel, how you doing today?
I'm doing great.
So, Noel has this background in real estate that sounds pretty impressive. So, Noel, tell us a little bit about you and some of the stuff you've been involved in.
Sure. I have a commercial real estate background. I started in Chicago back in the early 2000s in commercial real estate, and kind of fast forward to the real estate crash. I got into, even before the crash, I was really into a lot of single family residential investment real estate, working with a lot of different investors in Chicago and around the country, actually. So when the institutional funds started to buy, particularly in Chicago, I was connected with Blackstone, and we had a team that was a war room, and we bought about 3,000 properties for institutional funds in Chicago. And that kind of really got me into the space, and which has brought me here.
Cool.
So
fantastic.
Working with a property management company.
So Noel, tell everybody a little bit about Renters Warehouse.
Sure. Renters Warehouse is a national vertically integrated third-party property management company. Manage about $3 billion in residential real estate, servicing 12,000 different investors, 16,000 homes in 18 states, 33 markets. We're one of the fastest growing, highest rated property management companies in the country. We have a centralized service model, which creates a lot of efficiencies, and we're backed by private equity. So we used to be a franchisee operation. About a little less than a year ago, we had a private equity group invest into Renters Warehouse, and now we've rolled up most of the franchises, and we're expanding rapidly. We're adding about 1,000 to 2,000 doors a month in our pipeline, and a market a month. So we're going to even increase those as we're adding a lot of technology and a lot of tech initiatives to enable us to add more doors and grow faster. So what's great is that we can grow into any market. We don't have to set up a lot of infrastructure in a market. So if an opportunity comes up in a second tier market, even that we have investors or an acquisition target, we can easily go into that market. We're really going where the opportunity is, along with a planned growth strategy.
Okay. So you are the guy at Renters Warehouse that helps them to grow through acquisition. Is that correct?
Yes.
And
yes.
So this is what we're going to be talking about today, which is the art of buying and selling property management companies. This is something that a lot of property managers want to do. They're not able to do. They can't figure out how to approach other people. There's a lot of questions. There's issues with evaluating and churn and all these different things. And there's a lot of potential pitfalls when it comes to buying or selling or merging or doing anything of the sort in property management. So some of the things that we want to make, that Noel and I wanted to make sure that everybody got out of this event, is to learn what big box companies look for when they're evaluating and buying property management businesses, because a lot of people start with the intent to someday cash out. And then we're also going to take a look at how to properly value your company and portfolio. We'll talk about some of those things, and we're going to talk about how to set up your business so it's interesting to buyers. And then I think we'll also touch on the opposite side, which is, how do you find companies to buy? How do you do that if there are people looking? I think you have some great insights to share on those things. So let's get into it. So let's talk about some of the common mistakes that buyers make, right? That are buying companies. And these are things that you're geared to avoid. So what do you think is the most common mistake that people make when they're buying a company?
Well, location, or let me backtrack a little bit. Really taking a good look at the how well the portfolio is performing, how, what the tenant type is. Is this a D-class portfolio? Is it a C-class portfolio? Really looking deep into, whether there's a lot of tenant issues, whether there is a lot of churn happening in the portfolio already? Is it being mismanaged? Don't get caught up. I mean, we would rather, for example, buy a portfolio that's 200 doors, that's very well managed, and that's a good portfolio than a 1,000-door portfolio that's going to cost us a lot of money, and it's going to be a big issue. Now, there's benefits, pros and cons to both. I mean, we'd love to buy the 1,000-door portfolios, but those we take a closer look at. Also, looking at the investor, the owner mix. So is this 200 doors with 3 different owners, or is it 200 doors with 100 or 200 different owners, or is it 1,000 doors with 5, 6, 700 different owners? That's a lot less risk than a portfolio that, for example, we're looking at a portfolio that's 1,200 doors with 5 owners. That's a very high risk portfolio because churn has been a big issue.
So churn seems to be a real common issue. And you had mentioned to me previously that not structuring the deal for the churn is like one of these biggest mistakes. And so how do they account for churn? How do they deal with churn when they're purchasing a company?
So what we do is we take a look at, we look at the makeup of the portfolio as far as owners. And when we buy these portfolios, we usually, you're kind of married to the seller for a little while. So we incentivize the seller and the buyer to mitigate churn, because for one, we don't want to buy a portfolio that we end up not buying as much as we thought because we lose a lot of deals or a lot of doors, or the seller. So what we do is we put in a churn factor. So we'll say 12 months capped at 15% is the churn. So anything up to 15%, any door that leaves in that 12-month period, we're not going to pay for. And sometimes it's negotiated down, sometimes it's negotiated up, depending on how risky the portfolio is. If it's a single owner or there's not a lot of owners in that portfolio, then we'll have a higher churn rate. If it's a lot of mom and pop investors, there's going to be less churn. And if one person leaves, it's not going to affect the portfolio as much. So we'll incentivize the seller to make sure that there's a smooth transition. And that also leads to some of the things as a seller as well. This causes the sellers to really do a lot of due diligence on us and what our process is and what the integration period is and how we're going to integrate that portfolio, and down to the verbiage of the letters that we send out to the owners, how we're going to meet with the owners, all those things. So it really causes both sides to really get to know each other and be comfortable with the transaction, so we don't lose any doors, because even if we don't have to pay for them, we still don't want to lose the doors.
Yeah. So in regards to churn, is churn inevitable?
Oh yes, that's why we'll cap to a certain amount of churn, because churn is inevitable.
There's always going to be a certain amount of churn, and I think this is a mistake. A lot of people think, "Man, I'm going to buy a 400-door company, and I'm getting 400 doors."
Yes, exactly. So there's always going to be a lot of churn, or not a lot of churn. There's always going to be churn, and you can only mitigate it to a certain amount. So a lot of times we'll even, depending on the type of transaction, there'll be a period of, especially if the company's got some great marketing in place, and so there's going to be a lot of residual doors coming in, and we may lose some doors. So for a period of time, we'll let them, some doors can be added. So it's really a net number, what was added and what was lost during this time period. And usually the added doors aren't for the full time period. It's usually a shorter time period. But a lot of guys have some great marketing going on, and so it's kind of like, what do you do with that? What do you do with those doors that are going to be coming in? And for a bit of time, we'll let those be added if we like what they're doing.
Got it. Okay. So another challenge you had mentioned to me is closing too quickly, not doing their due diligence. So how do you see this play out?
Well, for the reasons of the churn and understanding the tenant mix and what's going on with all the individual owners, closing too quickly can be a big issue. If you close quickly on the portfolio and you haven't done your due diligence, you're either going to you might hit your limit on churn and lose more than that 10 or 15%. You might you just don't know what you're getting. So you really have to do a lot of due diligence, really understand each property, what's going on. You'll have properties that maybe the owner hasn't paid for a turn in several days or a few months, and so that's an issue. That's a door we usually wouldn't want to buy, or we would add that. We even will take doors that we'll exclude out of the churn rate on the front end. So say, hey, these 20 doors, we're excluding them now. If you add them in later, we'll pay for them, but right now we're going to pay for the doors that are performing. And so that's one thing that we do. We don't we only pay for that are under management that are performing. So they don't necessarily have to be rented right at the time, but they have to be, that there's a management agreement. They're being leased, and it's not like they've been leased for 3 months and they haven't been able to find a renter, or the landlord hasn't paid for a turn in 2 months. We'll red flag those doors, and they can add them in later, but up front we're not going to pay for those.
Right. So,
and that's where that churn kind of works in both ways, in favor of the seller and the buyer. So you have some time to figure it out.
So how do you look at the portfolio? Because it sounds like what you're saying is that you need to know how the portfolio is made up, and not every door is worth the same equally. So it's not just like, we'll give you this much per door. It's what's the portfolio look like? How do you evaluate that?
Sure. So, I mean, first off, it's what are the doors? I mean, so we like to look at, a lot of people don't want to give up a lot of information in the beginning. So, ideally we want to see a P&L statement. We want to see where the zip codes and the street names of the properties. So we're not really concerned about the actual address, but we want to see, okay, we've got properties in 60642 and it's on Tellman Street in Chicago. So we can kind of get an idea of the neighborhoods. We will look at we're more concerned about the revenue, not the expenses, because we're buying the doors. So how somebody operates their company on the back end, and how they run expenses. And a lot of guys are running their, personal expenses through the company, and cars and all this kind of stuff. That's going to affect their net revenue, or they might have not enough employees or too many employees, or they're monetizing the repairs and maintenance, which we don't look at. So we really look at that gross revenue. We look at the makeup of the portfolio as far as the owner mix. We look at what the churn's been, how many doors they've been adding. And so it'll tell you a lot how they operate, and how happy the owners are going to be, because that's really a big thing. And also tenants as well. So we kind of look at all those things, and we don't have a formula. I mean, we have a formula based on the financial numbers, but there's a lot of things that are look and a feel, and talking with the seller and getting to kind of understand their operation. So we kind of put a risk to the portfolio, and that does affect what we pay.
Yeah, I think that's interesting. So you're not so concerned about, what the company's expenses and costs are, because if you acquire them, you're going to bring your model to the table. You're going to deal with that. So you're really just concerned about the gross, the revenue, and how that might fit into your model. So, so what if their structure, their pricing, and their model is completely different? Let's touch on that. So
yes, so that will affect the churn. Sometimes in a positive way, sometimes in a negative way. So if, so we're a flat fee model. We charge between $89 and $99 a month. We charge $350 for a renewal. We charge 1 month's lease for a lease up. We don't have a lot of admin fees. We don't have a lot of what I call junk fees. So if this is a portfolio that's charging, 5%, and it's averaging out to $69 a month, and they don't charge renewal fees, they charge only a half month's leasing fee, then that's going to be a way more careful, integration, and it will be worth less to us. So what we don't do is we don't switch everybody over when we buy immediately. We'll let the current contracts run out. So if they have a model that's very similar to ours, we look at that, and there's going to be less churn, there's less risk. We feel more comfortable with that model, or with that acquisition. If they have a model, and also if sometimes the pricing is way higher than ours, so that could be a positive thing as well, because we'll let those contracts run out. So we like to see, where all the contracts are, when they're going to be released, when the turnover, when the renewals are going to be. And so we put that into our model for our EBITDA. So throwing that in a 3-year model, we look at where it currently is, how it's going to perform, and then when we switch it over, how it's going to perform. And that's how we come up with a price.
Gotcha. Okay. So another common mistake then is just not having a really well drawn out plan for the takeover or for the acquisition.
So yes. So what we see is, a couple of things is that they're not monetizing, they're not charging the right fees. They're charging too little. Usually it's rarely too much, because it's a pretty competitive market, right? So, and they also, and kind of another thing is that we see a lot of people say, well, I've spent all this money on technology, I've spent all this money doing all of these things, and so it's worth X. Well, it doesn't work that way. It's how is it performing? Hey, can everybody hear me? I saw somebody.
I hear you fine.
Okay, you hear me fine. Okay, so it's not, how much time and effort and energy and sweat you put into it. It's what kind of revenue is there. So we really have to look at that. So especially people who've just started out and they've grown a great portfolio and they've gotten a lot of doors, and that's great. And it's valuable to us, but it's probably not as valuable to them because they've spent a lot of money up front, especially the guys who have done well and they've created some great systems and they're going to grow. It may not be a good time for us to buy them because they're really not going to get to monetize all of that money they've spent in time building that up.
Great. So let's look at the mistakes that the sellers are making, right? Because I mean,
Sure.
most of the risk, it sounds like, is on the buyer. But what are the
Absolutely.
mistakes that the sellers kind of make?
Well, what I just mentioned. So most of the biggest mistake is people valuing their time and energy and work they've put into something, and trying to put a number on that compared to what the revenue is.
Okay.
So that's a huge mistake.
So overvaluing their company
Yes.
in general. So everybody loves their company. It's their baby, right? And
Right.
they put years of time, energy, and effort into it, blood, sweat, and tears. They've had sleepless nights trying to figure stuff out, and they feel like this is worth a lot. And so is it a challenge to break it to people what it might really be worth?
It is. And usually what happens, and so I saw somebody ask me this question as far as what kind of, do we use a multiple? Yes, we use a multiple based on our model. So our multiple based on our model might be a multiple for the seller. It might not, because if their model is very unique or different and it works for them, but it's not going to work for a couple of things. So a lot of people have a great model that's good for managing 200 doors, but it's not good for managing 2,000 doors. It's sometimes too hands-on. It's not scalable. They spent too much on technology, all those types of things. Or their fee structure especially is different. I mean, we've run into guys who charge, they don't charge release fees. They just charge for the time that it's listed per week, some weird things, and so that really negatively affects the model because you're going to have a lot of churn when you switch people over. So, we base it on our EBITDA and we base it on what we'll do. So, a lot of those things, a lot of just not really truly understanding what they have. A lot of people don't even know what their costs are. And another thing we see is that we don't buy the maintenance and repair companies. We found that is it's a tough business, and most of the time, when we look at a portfolio and we see that they've got 60% of their revenue is from maintenance and repairs, that's usually not a good thing, because they're charging too much. They're focusing on the repair business. They created some people create a property management business to feed their repair and maintenance business, not to manage the doors and those things.
Right. So some businesses, I've heard business owners say, well, I'm only willing to sell if you also buy my maintenance company, because my maintenance company is half of our revenue.
Yep, we're not interested in doing that. We feel that just we don't monetize repairs and maintenance, so it really we're truly acting in the best interests of the owner. And so, kind of not to get too off topic, but some calls in, we're about escalation avoidance. We're about not getting somebody out there. And if your revenue is from the repairs and maintenance business, it's hard to have your everything aligned.
Right.
So we don't like to buy that. So when they tell us that, we'll tell them that they can continue to. We'll use them as a vendor. We'll use them as the first right of refusal, possibly, but then they have to adhere to our standards, and we're going to be making sure that their pricing is in line of where it needs to be.
Great. So let's get into the question: how do I create a business that other people will want to buy? And maybe we can talk about your criteria.
Sure. So when we're looking at the pricing structure, so if a lot of people we see, especially when they're starting out, they will charge a lot less fees to get their business. So they'll give people that 5% fee, or make a lot of concessions to win the business. If their portfolio is too full of doors like that, it's going to negatively affect what we'll pay. So they need to make sure they get everybody kind of into a unified pricing. I mean, we've looked at portfolios where you've got 1,000 doors and 300 different pricing structures. And every guy they're kind of doing a deal with, they're doing deals with the tenants, they're doing deals with the owners, they're trying to do a lot of things. And so that's really hard to value. And it's not very attractive to buy because there's going to be a lot of churn.
Right.
So getting this pricing aligned, I think the flat fee model is a way to go. It works really well. We see guys who have a 5% model, but then that only works on high-end properties. It doesn't work when you start to scale it truly. So the main thing is knowing what you're, having a good P&L that you can read and understand, and not focusing on those expenses and actually how you run the business. It's really how the portfolio performs. I saw somebody asking about it in the notes. We're focused on the portfolio, not the business. We don't think that it's profitable to buy a business and let it run on its own. It has to, the reason we can have value add to this is our centralized model and plugging it into the way we do things, and which we think is better than most. So that's really the big thing is making sure they're aligned. And we've had some guys we talked to that are going in and they're over time getting their pricing more aligned with what we're doing, so we can acquire them. And there's also pros and cons to that, because what we'll pay today may not be what we'll pay tomorrow. So
So you're looking at the quality of tenants, you're looking at the quality of the owners, and you're looking at the quality of the properties, where the property is at. And then how about their online reputation and reviews?
That does make a difference. So one caveat to all of this is that if we're buying a property in a market that we have not established yet, we're much more interested, and this is something we haven't covered too, is current employees and things like that. So when we're buying a property in a market that we haven't established yet, we're very much more interested in how the business is being operated, who their employees are. And we're actually interested in the employees as well when we're buying a portfolio. So if we're buying a 1,000-door portfolio in a market that we have 1,000 doors, that means we're going to have to staff up, and we're going to need more staff, and we're going to keep on. So during the integration period, we will keep on a lot of the employees and continue to run that portfolio, and then slowly over a 45 to 90-day period, integrate that into our process. It's not and that's where that churn comes in as well. It's not we purchase it on day one, we integrate it into our processes, and we go. It doesn't work that way, because you're going to have a lot of churn. So we want to figure out what's going on with the portfolio, figure out who some of the really good employees are that are running that portfolio, figure out if they are good fits in our current model, and if they aren't, but they're great employees, we want to repurpose them to do some different things. So, one of the things that comes up a lot is the employees, and we don't come in and just get rid of everybody and just buy the doors.
Right.
We want to, because again, it's all about the
There
churn.
needs to be some
So we want
continuity.
to, absolutely. And there's in most of the property management companies, there's a few key people who have a lot of influence. They've brought in these owners, they're their customers, and we don't want them to run away,
Right. You don't want to just kill the relationship and then
yeah,
everybody loyal to
because
them
you'll lose people
out the door.
And then it goes into, if it's a new market, we will, in many cases, if they're great operators and it's a new market we're in, we'll take the owner of the company, and many times we'll become an employee of Ritter's Warehouse as a market leader. They get paid very well, and they continue to run a business that they've built up and put a lot of time and energy into, and have a lot bigger backing and scalability, and take a lot of things off their hands that they've been doing that our centralized services add. So that's kind of another caveat to all of this, is that as we're going into new markets, if it's a great operator, we'd love to, our first acquisition in a new market is always the most important. And that's where it comes into, we don't care if it's 1,000 doors or 200 doors. We want somebody who's a good operator, that might be a good employee, that knows the market, that knows what's going on, and that we can really grow them, and then go in and make some other strategic acquisitions and start organically growing, which is a big part of what we do.
So explain how somebody goes from being a property management business owner to an operator then.
So we've got a couple of acquisitions that we're working on right now that's the case. So we're not only evaluating their portfolio, we're evaluating them as operators, and do they fit into our culture? We have a very entrepreneurial culture. The market leaders in our markets can be very entrepreneurial and have a lot of say on what goes on, and they're really responsible for growing that market and training the sales agents and things like that. And then we take a lot of the heavy lifting things off of their plate. So accounting, dispositions, maintenance coordination, rent collection, all of these things we'll handle in our corporate office. So it lets them really go out and do what they're good at. And most of the time they're good at bringing in doors, growing the business. And so we really search in new markets for good operators. And we've turned down bigger acquisitions in new markets in order to get the right operator in place, because we feel that's the most important, that initial acquisition.
And so there's a real incentive then for somebody to let go of this being the business owner and transitioning to being an operator within your model?
Absolutely, there is, especially in new markets. In addition, we find a lot of our acquisition targets are people who have grown, 300-400 doors. They also have a great real estate brokerage, which we are not in the real estate business. We don't sell or buy, we don't represent sellers or buyers buying investment property. We would rather create a strategic relationship with somebody. So let me give you an example. So somebody has this great brokerage. They have 400 or 500 doors. They'd really prefer to run their brokerage and sell their property management business. And then we create a great relationship with them ongoing, where if any of those doors that we acquired from them, if any of those people want to sell, we'll refer them back over to that brokerage, and they can keep referring us doors and keep doing the business that they're doing and keep providing a great service to their customers, and not have to kind of give up that whole property management side of things. And that goes with whether they're a turnkey operator, whether they're, there's a lot of great brokers that work with investors that do a great job, and they kind of backed into the property management business, and it isn't what their core business is. And all of a sudden they've got, I've talked to some guys recently, have 1,200 doors, and it's not their core business. And now they're kind of struggling, and they'd rather just be going out there and doing acquisitions, finding properties for investors to buy, and really working that business. And that's what they're good at. And so it's a really good relationship for us to come in, and we can be an extension of what they're doing. And it works really well.
So quick question about that. So when you're looking at companies, to possibly acquire or to work with, what's the difference in perspective between those that are paired up with a brokerage currently They're kind of married. They have a property management arm or whatever, or those that are just property management companies?
For us, not much. I mean, we look at that. We look at the doors. So we look at the revenue of those doors. We're not concerned about the brokerage. It's just a different relationship. It's a little bit of a different conversation, because now they can, it's sometimes an easier conversation because somebody's not selling everything that they're doing. They're just selling something that they've, that honestly, I've seen a lot of guys, you'd be really surprised. I saw somebody accidentally picked up over 1,000 properties. You would be surprised how many people come back into it. They started managing their own doors. They had a couple investors come in, a couple more. And all of a sudden and then they decided that they want to grow that business. But what they didn't do was create a lot of systems from the beginning. So now they get overwhelmed. They get to 500 doors, 600 doors. They get completely overwhelmed. And the business is going to go in two directions. So most of the time when they get in that situation, it starts to go downhill. The quality of service starts to go down. I mean, we had a group that 4 or 5 months ago, the guy had 500 doors. We were going to offer him a great price. Today, the business is, and he turned it down because he didn't think it was, we offered him the right price. Now he wished he'd done the deal with us because he hit that critical mass and he didn't have the systems in place and he started losing doors. And it's a declining business, and we value that differently because you have a lot.
And now it's probably negatively impacting their reputation online, so it's probably affecting their real estate sales.
Absolutely.
Right. So, okay. So then I think what you're saying is for people looking to buy a property management company, a great target market or great target audience would be the brokerages that are almost accidental property managers.
Absolutely. If you ask them, I mean, I've met a lot of these guys, and they're sitting there with, 500 keys on their chain. They're on the phone a million times, and they're not doing what they want to do. And that goes with a lot of people in that business. They would rather be out there buying and selling properties, working with investors, and the property management is just a necessity. And it's either a necessity because they don't believe there's good property managers in the market. There's a lot of the property management business is very fragmented, or they're just kind of having to do it because they've fallen into it. They were in the REO business. Now they started managing properties, and those are great targets for sure.
So with the contracts or the company, right, there's two types of acquisitions. So tell us about the two types of acquisitions that Renters Warehouse looks at and whether this is a good fit for other property management companies looking to buy.
So you mean the difference between if we're buying a company or buying just the contracts?
Yes. Thank you.
Okay. So even if we're bringing on somebody as an operator within our company that we're buying, we still value it the same. But the difference is that now you're talking about, so if it's a new market, and they're great operators. We really like them. We're probably going to keep some of their employees. We'd like to keep them on board. We think they can really grow a market. It's really still about a door price because we have to value those two things separately. So we look at the door price and we say, okay, what do we need to pay this person? What kind of stock options can they get? What as well as a lot of things that I'm doing, that my team's doing, growing doors in that market, they'll benefit from that. So the caveat to some of those guys is, hey, here's what we can pay per door, and here's what you're going to get for all your hard work. Is you're going to get paid a salary. You're going to get a lot of the stuff, a lot of the things that you've been doing that you don't like doing. You're not going to have to do anymore. You can focus on growing the market, and that's going to be your upside. Those are those are rare instances. But since we're growing so quickly, it happens because we're growing into a market, and if that's a market we haven't been in, there's huge opportunities for guys in markets that we're not in currently to really monetize all the hard work they put in, because not only are they getting a multiple on their business that is probably, and their net revenue would probably take them 2 to 3 years to achieve in most cases. They're also going to get to even monetize it more by having a salary and having a great company that has a great culture behind them to really grow a market.
Okay, great. So let's take a look at some of the questions that some of our audience wanted me to ask you. Um, so I think we've answered some of these. Let me go through these. I'm looking at the ones that people threw into the chat that were ignoring the question and answer thing real quick here. But is your flat fee pricing uniformed across all markets?
It is. No. So it's $89 or $99 per month. We do give some discounts for small multifamily. So that can discount that fee. And on our larger markets, it's $99. On our smaller markets, it's $89 usually. It depends on what the marketplace is.
And so will that model work in like really high rent areas and also really low rent areas?
Yes, and here's why. For the high rent areas, we can take a lot of market share. So, we're looking at Chicago in the city where, average rents are $2,500 or higher. $99 a month is a great model. And we're able to really, I think there's a few people that aren't happy that we're coming into town because we're really going to push down the pricing. And then the lower end markets, it's, those are higher maintenance. Those are tougher to manage usually depending on the tenant type. And so we'll push our pricing down as much as we can, but it's, it seems to work because it's not about the lowest price. It's really about the quality of service. And so we really truly believe that our service is better and they're going to have lower repair and maintenance costs because we're really focused on escalation avoidance. We're very good at what we do. We're very good at tenant retention, very good at collecting rent, all those things. So it's a pretty easy sell for us. And we've had some investors that we've taken over in Kansas City and St. Louis and Cincinnati that are lower end properties, and our pricing structure still works for them because we're able to stabilize their portfolio. And then, so if we have investors with over, we also have kind of a portfolio services division. So investors that own more than 15 units they're getting some specialized services with a dedicated account manager, and that's something that a lot of guys like. And so usually it's very much of a win for the owners. So when we're acquiring a property management company, a lot of these sellers have built this up and they're very tied to their owners. And what we offer is a win for their owners. They're stepping into a situation where it's very well managed and professional, and they understand it. So that's, sometimes that objection is, well, these are their personal connections. Well, we do a very good job with them. So
let's talk about selling. So let's talk about finding people willing to sell. So when a property manager is looking to acquire, like my brother's like, man, I really want to just buy property management companies. I have the money to do it. We want to do it. I can't find anybody willing to sell. How do you approach people to have this conversation? Because property managers are pretty proud. They're entrepreneurs, they're business owners. And I doubt any of them are just going to say, hey, look at me really easily. So how do you find people that might be willing to sell?
Well, I'm here right now, so that's one thing. So it's really been connections. If you're in your marketplace and you know people, you start putting the word out that you're buying, as well as prospecting. So looking for property management companies, looking at how many current leasing, listings they have, kind of getting an idea, getting to know people. And I look on LinkedIn and randomly a company pops up. I'll call them up and say, hey, we're buying property management companies. Are you interested to sell? Many times they'll say no. Many times it's a lot more of a conversation. It's about networking and asking them if they know other people. There's a lot of different ways to work in with them. And, just because somebody says no today doesn't mean that next week or next month when they're having a real bad week that they will call you up and say, hey, I'm actually interested in selling. I can't do this anymore. I'm fed up with it. It's too tough, or we've come into the market and we're starting to eat away at their market share and they want to sell. I mean, there's a lot of different reasons, but many times people say no outright, but they'll come back or they'll throw out a number that's ridiculous, and then they'll shop around and realize
which starts a conversation.
Exactly.
Yeah.
Yes.
Okay. So just putting out the feelers and letting people know, reaching out to them, it can at least start the conversation. I heard a great idea at the NARP and Broker Owner Conference. It was mentioned to just, because they're proud, to approach them and just say, if we were to do something together, could we make more money? Is
Absolutely.
a nice way to kind of start having a conversation. Because
yeah. And like any small business owners, you're very proud of what you've done. So the approach is not, sometimes, I mean, you have to judge the person you're talking to, but most of the times it's not, hey, do you want to sell your business? It's like, hey,
right.
You're really good at what you do, and I really like what you've been doing, and I would like to, let's see if we can, monetize your business more than you are right now. I mean, the net revenue that somebody makes compared to what we can pay, usually it's 2 or 3 years of that net revenue. So it could be a good cash event for them. Maybe it's not buying all of their doors. Maybe it's buying some of them, letting them monetize some of their doors. That's something that we absolutely consider, especially guys who have the real estate brokerages. Maybe let them building up some doors if they have a good investor flow, and we'll buy a few hundred doors from them and let them build that business back up. Interesting.
So you'll buy just part of a portfolio. It doesn't have to be all or nothing.
As long as they're not just trying to, it doesn't have to be all or nothing. As long as they're not trying to just sell the dogs of the portfolios.
So, but maybe if they were trying, maybe it's more common that they're like, I don't want to drive out to this area anymore. Or
right.
We started a branch out here, but it's kind of difficult for us to manage. Maybe we could offhand that.
Exactly. So especially the smaller ones. Now, I saw somebody ask a question about no non-compete. So we like to do non-competes on bigger acquisitions. And if we're buying a property management company out and buying doors, we will put in a non-compete. If it's a smaller guys and they have, a brokerage and things like that, we don't always do a non-compete. So it's really situational on the non-competes. But we don't want to fund somebody to have the money to go in and create systems and then turn around and compete with us. That's not what we're trying to do.
Right. But these people may sell off a lot of their doors, and they might be small, and then they maybe can build up more, and you might take them again.
Yep.
Okay.
Or we just keep referring them over to us. It's the best scenario. But so non-competes are situational.
Okay, great.
I was going to say, I saw somebody ask about, is there a per door formula? We have a per door formula on our back end, but it's not a set formula. So you can't just look at it and say or gross revenues here, this is what we'll pay, because there's a lot of nuances to it. There's several different things. And I think one thing that we didn't talk about was the way we structure our transactions. We usually put down, and for several reasons, we'll usually put down, let's say 50%, and then we will the seller will carry a note for 3 years on the other 50%. And that is tied into the churn and keeping that churn in place. And it enables us to be able to acquire more doors and things like that. So, that is factored into the formula. And those are usually our larger transactions. On smaller transactions, we would pay outright, but we can be more aggressive on pricing and doing something like that because we're trying to grow so quickly.
Yeah. I think when people ask that question, they're thinking they're trying to evaluate their company right now. How much could I get? So if they are interested in figuring that out, so a lot of property managers, related, this is similar. A lot of property managers will offer like a free rental analysis.
Mm-hmm.
So maybe would it be a good strategy to do something similar? We'll do a free company analysis.
Absolutely. We will do that. Now we'll like to talk to them and we prefer if you're really interested in selling. But yes, we do have we also have a free rental analysis. That's a different thing, but sure. we will we will evaluate a portfolio and give you, if we can get some P&L. Really, like I say, we're more concerned about the revenue. A door count, ideally zip codes and streets that the portfolio is located. We can give within 24 to 48 hours. We can come back with a per door price before due diligence and come up with a number and start a negotiation. We can do that very quickly.
So do you recommend having some sort of agent go as the middleman to kind of broker the deal and handle the deal in between the two companies?
No. The reason being is that it depends. Is it a business broker or is it we absolutely will pay referrals, and we love it if, we say, hey, we're not interested in selling your company, but if you find us somebody that you personally know, and then you can help us get a deal done, we'll pay you a referral. So because we are trying to grow so quickly, we're not trying to capture every single deal myself. And if somebody brings, for example, if I'm already talking to somebody and and it's a larger investor, portfolio holder, or a property management company, and somebody also knows them and they can help make that deal happen, we'll pay them. We'll pay them a referral. It's usually between 1% and 3%, depending on the purchase price, or if they find us an investor that is a single family rental investor that's a portfolio owner that we can manage their properties, we'll pay a per door price for a referral. So we're open to doing that. We like to work with guys. We have some guys that have helped us refer some doors in and then decided to sell their company as well. So we're very open and very malleable in working with people, for sure.
So I think a lot of people watching this and even the viewers that are live right now will have a lot more questions related to some of this. So if people have questions or they want to start having a conversation with you, maybe evaluate their company, how would they get in touch with you?
Sure. One thing real quick, on new doors, if people just refer us doors a door at a time, we'll pay, we call it a realtor referral fee. That's usually around $500. So someone says, hey, I've got an investor, I'm going to refer a door in, we'll pay a referral fee ongoing, and we'll keep that relationship going as long as possible, even with that same investor. If anybody wants to get in touch with me, I'm on LinkedIn. My email is Noel C, that's Noel C at renterswarehouse.com. We're on Twitter, Pro Landlord. We're all over social media. I'm very accessible. Connect with me on LinkedIn or send me an email and we can have a conversation.
Fantastic. Noel, I appreciate you taking the time to hang out with me here. And I recommend you get in touch with Noel if you have questions about buying or selling your property management business and have a conversation. And you, like Noel said, you can reach out to him on LinkedIn or email. Noel, thanks for coming out.
Great. Thanks a lot, Jason. Really appreciate it.